Welcome to the InterMarket Analysis Update. This is a video that I do once a week where I look at other markets, not only in the S&P, but outside of the stock market itself, the Dow, the NASDAQ 100, but we also look across multiple markets because sometimes we can get some clues as to what's happening in the S&P by looking at other markets. Before I start, please be aware I probably sound a little bit different. The screen might look a little bit different. I'm using my backup system. I ran into some problems with my other computer. So all the videos I'm doing over the weekend, I have to do using my backup system. So please be aware of that. Also, this is all take one. I don't edit this video, so you're going to hear me stumble over words. I'm going to get things backwards. I might have to repeat myself and start again from time to time. So I ask your forgiveness beforehand. I still hope that you find this video very helpful. This is being prepared for Monday, June 12th, where we're doing pretty well in the market right now. The NASDAQ and the NASDAQ 100 have been really performing well, but we're hitting some major resistance with the S&P 500. We're right below that 4,300 level. The market has tried 3 times now to get above that, only to close below it. We also have the previous high set back in August. Can we eventually get above that? On a short-term basis, just looking at the S&P, we're quite overbought in the short term. We're kind of overbought in the intermediate term. So if we pull back or at least chop sideways for a while to work some of that off, that wouldn't really be a surprise. So the first thing that we look at when we're talking about intermarket analysis is we go through valuation. Is the market considered expensive, fairly priced, or cheap? This first chart looks back historically. We look at the trailing 12 months thing called a PE ratio, the price to earnings ratio. When this gets really out of line, that means that a stock is expensive. When we get to that Goldilocks area, it's fairly valued. When the stock price has really gone down, but earnings are still hanging in there, then the PE ratio really drops to a low level. Right now, you can see on this chart, and I don't have my laser pointer here like I usually do, but the black line here is the S&P, and it's been going up. Well, this red dashed line is the PE ratio of 20. You can see by the legend here, when we get 20 or above, the market is considered to be expensive. Well, we're above that right now. Down on the bottom, I have a calculation of the spread between the two. When we're above this zero line here and going up, that means we're above the PE ratio of 20. So that's looking historically. Now we look at the next chart, which, and it's taking a while for this to load, these are different events going back to 1980, the 87 crash, the dot-com boom and bust, the housing crisis. Of course, we had the whole COVID plunge up to where we're at right now, just looking at different events that have happened. And then you have the red line, the blue line, and the green line, which track the various PE ratios as they change over time. Now that's all well and good, but then Robert Shiller came along and kind of improved on this a little bit, where he takes more of an average because anything can look good for a short period of time. What does it say when we look at 10 years or so? He came up with the Shiller PE ratio, and here's the chart going all the way back to the 1870s or so, and different events that have happened on this chart as well. And right now we have a reading of 30.09. Okay, what does that mean? Well, that's what this other little graph up here shows us. Over time, the median and the mean has been about 16 up to 17. And right now we're reading at 30. So on a historical basis, we're looking expensive based on this chart as well. Now this can last for a long time. If I go back to this other chart, this goes back to 1980. And we can be above or below these lines for a long time. We just use them to get an overall look at what is the value of the S&P 500 itself. But the market doesn't do that. They look forward. So then we have some forward-looking PE ratios. This is based on the S&P 500. And as of Friday, looking forward, now this is based on analysis, and these are guesses, and these can be modified and they can change, where looking back, you can't really change that information. but we have a current PE ratio looking forward on the S&P 500 of 18.5. We're under that 20 level, but we're above the 15 level. We also look at the mid caps. They're under 15, even though they had a pretty good week this past week. They're at 13.5. And we look at the small caps, and they're also at 13.5, and they had a really good week this past week as well. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high. Value is when, we're running into some problems in the market. So you might take your money and get into a different company that maybe has been around a long time. They're kind of boring. Maybe they sell things that people have to have no matter what's going on in the economy. So you shift over to that. And maybe you're getting some dividends from value stocks. You're not really seeing capital growth. You're seeing more income based on the profits that they make. So you make your return that way. So the first thing that we can look at is the peer growth index. This is just growth. Well, it continues to be in a downtrend. The blue line is below the red line. The blue line is a 50-period simple moving average. The red line is a 200-period simple moving average. Okay, let's look at the next index, which is value, where this is also going down too. Well, what are we going to do about that? Even though it's showing some improvement here, the blue line is below the red line. So what we do is we take some ratios. We look at both of them together. On top, we have growth versus value, and we're just seeing a recent golden cross with this ratio showing that growth is starting to outperform value. Independently, they're still in downtrends, but growth compared to value is starting to do better. On the bottom, we see where value had been doing quite well, but now we're seeing a death cross with this ratio here. So that suggests that maybe the market is shifting a little bit more in favor of growth. That's when we see really nice advances in the overall indexes. Then we look at a number of different charts comparing the same thing, a growth versus value ETF. Starting to see a golden cross in this ratio. Growth is looking a little bit better. Then we look at value to growth, an inverse of that same chart. Value is now starting to underperform. Then we look at an index, another index, growth to value, where this is starting to come back down, but growth is now actually crossed over positive and is starting to outperform. This is an inverse, value to growth, where value is now starting to underperform. Even though it says value outperforming growth, it should be underperforming growth. Then we look at this where growth is now giving us a recent golden cross and it's starting to outperform value. And then we look at the small caps. If you look at just the top part of this chart, we've been going down and people have been really discouraged about small caps until lately. This past week, they've seen a real run up. But during that same time, we look at small cap growth and compare it to small cap value, and it's doing fairly well. Now, we have seen some weakness, and we ticked down even a little bit on Friday, but overall, this is performing quite well. We can also look at the mid caps. Back to the beginning of 2023, all the way up to the current time, this is an overall uptrend, even though the mid cap index has been going down. We also look at growth to value in a little different way, using our rainbow chart, where growth had really been underperforming, and now it's starting to show a lot of improvement. We're coming back down to this blue moving average, which is based on 20 periods. That's a short-term moving average. And let's see if it continues to go up. Then we look at an inverse of that same chart, where value had been doing a lot better. It's starting to underperform, coming back up to this 20-period moving average again, and we'll see if it continues to go further down. Then we look at the bigger picture here, the S&P growth to S&P value, where it's starting to get in an overall uptrend. We saw a recent golden cross where the blue moving average is moving above the red, but we're seeing some weakness coming in to this ratio overall. Some inflation, want to keep an eye on that. This is a monthly chart of the CRB index. That's what we look at to give us an idea of what's happening. And I have a lot of other charts that we look at as well. That's in an overall downtrend. We're below this 12-period moving average. This is a monthly chart, so I put a 12-period or 12-month moving average on here. We compare that with an inflation to deflation ratio, which is down below. The red line is declining, and we're below the red line itself. That would suggest from a CRB perspective and looking at the different commodities that we continue to decline. Then we look at the Baltic Dry Index. What does it cost to ship things from one place to another? When that's really going up, it costs more. When it's going down, it costs less. Well, we are in a downtrend, so it is costing less to ship products. Then we look at the CRB all by itself. This is a daily chart where back about a year ago now, we actually crossed over and have started to assume a downtrend. Over here on the left-hand side are the different things that make up the CRB index. Some other markets that we look at: aluminum, downtrend; corn, downtrend; wheat, downtrend; fertilizer, downtrend; oil, downtrend; gas, kind of a downtrend. Then heating oil. Want to keep your house warm? Probably not in the summer, but it sure comes in handy in January. That's in a downtrend. Natural gas also in an overall downtrend. Diesel. What does it cost to ship products by truck, rail, or even boats or ships? It has been going down as of late. Lumber also in an overall downtrend. Copper. Now, this is a little bit different. We call this Dr. Copper. When it looks like the economy is going to look better going ahead, like it was back in 2020, with all that stimulus coming in, all those benefits, people not having to pay some of their bills, copper just really took off. Well, now that we're hitting a more difficult time economically, copper has come under some pressure. We also compare it to gold, and that's our next chart. Gold is in an overall uptrend. Then we take the copper to gold ratio. When the economy is looking better, we see this ratio going up. When the economy is looking worse, we see this ratio going down, and that's what's happening now. Doesn't necessarily mean we're going to head into a recession. It does suggest what we've been seeing in other areas, that the economy is slowing. Then we take that same ratio and have a longer term look at it, going all the way back to 1980, where that's the black line, and it's been going down overall. To give us a little more insight, we plot a 2-year yield on here, and the spread between the two is quite wide. You can see historically where they tend to go in the same overall direction. To get a little further outlook, we also plot the 10-year yield on here as well. And that is also quite a ways away from the copper to gold ratio. This is suggesting economic weakness. Silver came right back up to its 50-period moving average and started to come down, but it's in an overall uptrend with the blue line above the red line. Then we look at gold, that's the top chart, silver, and just notice that there's a pretty strong correlation between the two, which is not necessarily a surprise, but now we have a chart to back up that concept. Then we look at the gold to silver ratio. I take a gold to silver ETF, make a ratio out of that, and you notice sometimes when gold is outperforming and other times when silver is outperforming. On the bottom, we then have the dollar index. And as a general observation, when the US dollar index is going up, the dollar is getting stronger, gold outperforms silver. And we can see that. When the dollar was going up, gold was outperforming silver. Now they both can be going up, but which one's going up faster? The other side of this is when the dollar index is going down, like we saw near the end of 2022, and the dollar's been a little bit weaker going into 2023, then silver outperforms gold. All right. So again, keep in mind that they can be going in the same overall direction. We're just seeing which one is outpacing the other. And the relationship is still pretty strong here, but it's starting to wear off just a little bit in this overall study. We look at the dollar, want to keep an eye on that, where it has been in an overall downtrend, bouncing back up, but over the past week has seen some weakness. Look at the euro, which has been bouncing back up just a little bit compared to the dollar. And then we have the dollar index on the bottom. Then this is probably a little hard to see. The Japanese yen has been falling as of late compared to the dollar, as has the euro. And then we take the Japanese yen all by itself. It's in an overall uptrend compared to the dollar, but it has been showing some weakness. The British pound is also in an uptrend compared to the dollar. Then we look at some different indexes, and I go through this in the daily video that I put up there, where the red line is the equal weight index, where every stock in the S&P counts the same. In the regular S&P index, it's weighted. So the big companies like Google, Microsoft, Amazon, Nvidia, if they're having a good or a bad day, they can take the whole S&P 500 either up or down with it. Then we look at the S&P 500 or the CRB index, where for 2021 and into 2022, the S&P was underperforming, but now it's starting to be in an uptrend. Here's an inverse of that same chart where the CRB had been strong. Now it is weak overall. The NASDAQ 100 compared to the S&P 500, well, they're both going up. They're both doing pretty good right now, but the NASDAQ 100 is really outperforming the S&P 500, where it had been in a real downtrend in 2022. How about the S&P 100, the biggest stocks in the S&P compared to the rest of the S&P? They are really outperforming. So this just also suggests what you probably have heard, that it's the big companies that are really strong right now and are helping the market to go higher. Small caps are underperforming and in an overall downtrend currently. And then we compare the NASDAQ 100 to the NASDAQ. They both have been doing quite well, but the NASDAQ 100 has been really outperforming the NASDAQ overall composite. Then the NASDAQ to the S&P. NASDAQ doing better. They both have been hanging in there pretty good, but the NASDAQ has been outperforming. We look at some other stocks. This, and I go through this in the daily video as well. This is the NYSE advanced decline line on top, where it showed some recent weakness coming down to its moving average. The S&P advanced decline line rolling over a bit, seeing a little bit more weakness when we look at the mid caps and the small caps. We look at the biggest software companies. They're in an overall uptrend. We look at the big monster mega cap growth. They are really what's driving the market higher currently. Then on top, we have the S&P, and then this is the mega cap growth, the ETF that we just looked at, and compare it to the equal weight ratio, and it's really outperforming the smaller stocks. We look at robotics and AI. This is a relatively new ETF, and I have a rainbow plotted on here. They're doing quite well. They're above all the moving averages in the rainbow and continue to advance. But how are they doing compared to tech? With the ratio, they're not really doing all that great. They're up and they're positive, but they're not outperforming the tech sector itself. Okay, then the next chart we look at is the Dow Jones Composite Average. We take the Dow, the transports, and the utilities and put them together in one overall index. We've been pretty much chopping sideways, but we're still in an uptrend. Low volatility stocks, they held up a lot better in 2022. How are they doing now? They're chopping pretty much sideways. They're still in kind of a weak uptrend. But when we take a ratio of the low volatility ETF to the S&P, they are really starting to underperform, meaning that growth is seeing a lot more favor right now. FANG stocks, Facebook, Amazon, Apple, Netflix, Google, and a whole lot of other ones, they are going up really strong right now and in an overall uptrend. ARK having a little bit of trouble there, but seeing some bounce as tech has been doing better. We haven't quite come up to a golden cross here yet. You might be able to make a case for that, just a little bit above. So that could be starting to turn more positive. Dow theory, another thing that we keep on an eye on for the overall picture of what's happening. Where the Dow had come back up to recent highs, transports didn't do that. So we're seeing a longer term negative divergence. Now, I also include utilities in Dow theory. Shorter term, utilities have been showing some weakness, so that would be a shorter term negative divergence. Then we have a new look at Dow theory, where instead of using the Dow, why don't we take the S&P 500 on top, and instead of the transports, we take NASDAQ, because it's most technology things that are driving the market now, where 100 years ago it was trains and being able to ship things around. When we look at the top, the S&P is breaking out above this one resistance point that we had hit and is looking good. Well, when we look at the NASDAQ, it's also been breaking out. So we would call this a positive divergence. They're confirming each other. Then we look at some longer term charts and go out and look in different areas. We look at Europe, Australia, Asia, and the Far East. We're still above this moving average. Now, keep in mind, this is a monthly chart. So that's looking a little bit more positive when you compare the S&P to some world stocks. And if you look at the bottom, this is the percentage price oscillator, which is a momentum oscillator, and it's starting to turn back up as well. So longer term, we're looking better. Looking at bonds against stocks, we have the total bond ETF chopping more or less sideways, but still in an uptrend. The Pring World Bond Index, really choppy, but is still in an uptrend. Stocks to bonds, what's the ratio looking like on a monthly chart? Stocks continue to outperform bonds. Bonds continue to underperform stocks. High yield bonds, which are junk bonds, they are still in an overall uptrend and have actually been performing quite well. How about investment grade bonds? Also in an overall in an overall uptrend, but pretty much chopping sideways. How about the correlation between stocks and bonds? It's pretty much neutral. They have a tendency to go in the same general direction when bonds are going up and stocks are going up. That's in a better economic environment. When we get more defensive, bonds will often go up and stocks will go down. Sometimes stocks go up and bonds go down. Right now, they're not quite sure what they want to do. Here's the corporate bond index, kind of a forgotten market to a lot of folks, still in an overall uptrend, but chopping sideways. Here's the 10-year yield. And then we have some Fibonacci lines on here, but we're well far away from those. Here's just a look how we broke out above this previous high with the 10-year yield. This is comparing the S&P 500 to the 10-year yield, and now the S&P is starting to outperform. The 30-year yield also above the 61.8% retracement level, and so we're not really getting an awful lot from this chart. Junk bonds are still in an overall uptrend. When we compare junk bonds to government bonds, junk bonds are outperforming. That's the way it should be. These are higher yield, more risky bonds. That's why we call them junk, because they give you more of a return, but you're also taking on more risk at the same time, where government bonds are considered to be very safe. All right, let's look at a daily chart of the yields where we've been going up overall. And you notice the 3-month is on, I guess that's the 2-year is on top. We have a lot of inverted yield curves right now, suggesting that economically we might be heading into a recession. Here's a weekly chart looking internationally with the US, UK, and Germany on top. And then down here on the bottom is Japan, and that's red. And we're keeping an eye on that because they have their own little story. They've got their own problems. So far, it hasn't gone to the contagion level yet, but we're still watching that. And when that happens, I will be certain to tell you about it. Looking at a weekly chart of the 5-year yield, it's in an overall uptrend. Short-term basis, we're going up. Intermediate term, kind of still going down, and we're still declining in the long term when we use the KST momentum oscillator. Here's another look at the 5-year yield. This is a daily chart where we're coming back above the moving average, but the special K, which also is a long-term momentum indicator, it is in an overall downtrend. A shorter term look at the KST shows that we are in an overall uptrend. So we're seeing a little bit of contradiction here. We look at the long-term bond ETF. That's based on price, not the yield, but the price of the bond. In an overall downtrend, short-term declining, starting to roll over in the intermediate term, but we're still in a long-term uptrend. Then we look at bonds based on price, and then we compare it to the CRB ratio, where bonds have been coming down in price. They're below the moving average, but they are outperforming the CRB index. Then we look at the MOVE index. This measures volatility of bonds where they've been dropping lately as the VIX has just been going through the floor. And there's a real strong correlation between the two. We just want to watch this chart to see if it gets out of whack with each other. I look at the correlation. They're tending to go in the same direction. So it's not really telling us an awful lot. Now we're looking at riskier bonds, which could be junk bonds. When people feel better about things, they're willing to take on more risk, and we're comparing that with more conservative bonds that are safe. The riskier bonds are outperforming. We're above the rainbow. And we're looking at a broad measure, the S&P 500, and comparing it to shorter term yields. I made a video that kind of focused right on this, and then another chart that I'll show you, where for a long time in 2022, the S&P was underperforming bonds, even though bonds had a terrible year. Now it's looking like the S&P is starting to outperform at least the 1 to 3 year bond ETF. Then we look at the bond market and compare it with further out bonds, also looking a lot better, above the rainbow and advancing. The tech sector is really starting to outperform the bond ETF. And then other sectors that we look at, On the top, you'll see the S&P 500. Then we do a ratio compared to materials. Materials are underperforming. Communication doing well. This is where a lot of our growth and a lot of our upward movement is coming from. Energy, which was really good in 2022, is now underperforming the S&P. The financials with the bank information that's been coming out, they're in a downtrend. The industrials, also a recent downtrend, they bounced back up, came up to this moving average and are now turning back down. Tech, which has been doing good again now, is outperforming the S&P. Staples, which did well in 2022, or at least better than other parts of the market, now it's really starting to underperform. We had a recent golden cross only to see some real weakness in this ratio, and we've seen a death cross. Real estate in an overall downtrend compared to the S&P. Utilities in an overall downtrend compared to the S&P. This is another thing that can give some support to the market. When the S&P is outperforming utilities, you can see what the S&P above did. Well, we're starting to go back up now. Will this give some support to the S&P itself? Healthcare. Got to have healthcare no matter what's going on in the economy, but it's really underperforming the S&P. Here's another look at healthcare showing the ratio. If I can hit the right button here. Okay, we got a little out of line here. It's in an overall downtrend when we look at this ratio. Then we look at discretionary, the things that make life interesting compared to the S&P 500, where discretionary is showing some improvement, even though it's still in a downtrend. Staples, the things you have to have, toilet paper, toothpaste, that kind of stuff. It came over here and gave us a really good up move, but it's been showing some recent weakness here, and it's kind of camped right along its 200-day moving average. If this keeps going sideways to down, we might see a death cross with this overall trend kind of soon. We look at the tech sector, really struggled in 2022, now is in an overall uptrend. Tech to the S&P, also really outperforming. Saw a version of that earlier. Semiconductors crossed back in early 2023 and have been doing quite well. Energy, which did great in 2022, is now really underperforming the tech sector. Growth, which are the buy low, sell high, compared to bonds, the growth areas are really outperforming bonds. The tech sector, to the rise in interest rates, really suffered in 2022, now starting to outperform. Here's an inverse of that same chart. The rise in interest rates, now we're starting to see that decline. Discretionary to staples, looking at it a different way. We're getting ready to see a potential golden cross with the blue line crossing back above the red line, and discretionary is showing a lot of improvement. Inverse of that same thing. Staples are getting to the point where we might see a death cross with this ratio as staples underperform discretionary. Gold, still in an overall uptrend compared to the S&P, but seeing some recent weakness. Gold to the dollar came right up to this trend line, and on the weekly chart, it's a little more pronounced. We actually hit this level. It was a little bit different, and it's starting to come back down. And then this is our intermarket analysis chart going back to the beginning of 2023, where on the top we have stocks doing the best, followed by gold. Then the blue line is bonds. Are bonds, is bonds. And then the green line is the dollar. And now what was so strong in 2022 was energy. It's now down going back to the beginning of the year. High leverage loans. If people thought that the economy was going to fall off a cliff, would they be going out and getting these really risky loans? No. This ratio, this isn't a ratio. This is an ETF, shows that we're really in an uptrend overall. Then we look at small caps compared to the S&P 500. They're really underperforming. What would really help us is if this red line could really start to go back up. A lot of times that really helps out the blue line, which is the S&P 500. The NYSE composite, chopping sideways, but still in an uptrend. The Wilshire looking a little more positive. All stocks also looking pretty positive. Emerging markets kind of going sideways overall, but still in an uptrend. Bitcoin, it's still in an uptrend. It's falling back. There was some negative news this week where they're suing Coinbase because they're not regulated in the US. But so far, Bitcoin's fallen a little, but it's been holding up overall. Looking internationally, China is trying to turn up from a downtrend. Emerging markets starting to turn back up. Europe turning back up. And Japan is also trying to turn back up, and the US, as denoted by the S&P 500, is also looking more positive. Some correlations. We look at the S&P against the dollar. They're having a slight tendency to go in opposite directions. S&P to oil having a slight tendency to go in the same direction. S&P to the 10-year yield, a little bit out of the neutral area, but a slight tendency to go in the same direction. The tech sector to the rise in interest rates, still a not real strong relationship here, but having a tendency to go in opposite directions. The S&P to the 2-year yield tending to go in the same direction. Then we look at the home builders. We're not really seeing much of anything in this chart right now. On top, we have the S&P, then we have the home builders ETF, then we have the ratio between the two, and then at the bottom, we look at the correlation between them. And when this gets kind of down here where there's yellow areas are, that's when we really take notice of this. We're looking for some kind of divergences. Right now, we're not really seeing anything that's all that crazy. Then we look at the long-term secular, that means decades long, and compare it to cyclical trends, which could be years long. Here's the NYSE composite with a monthly chart and the Copic curve on bottom. We're slightly above the moving average up on top, but the moving average itself is still going down. On bottom, we have the Copic curve, which is another momentum oscillator. It is going back up. We also look at the NYSE with a thing called the NYSE record high percent index. That continues to advance. Then we look at the S&P with the percentage price oscillator. That longer term is looking better. We compare the S&P to the CRB ratio, to CRB index, and then take a ratio where the S&P is outperforming. We look at the S&P again globally, where we're showing some weakness on this chart. So what is positive? And this list hasn't really changed all that much. My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. The big software companies, the euro, yen, and pound against the dollar. Copper, even though it's chopping around, is still in an uptrend. Gold and silver, even though gold has been pulling back a bit. The big boys, the mega caps, the low volatility ETF, even though it's showing some weakness, is still in an uptrend. The Dow Jones Composite Average, even though it's chopping sideways, the FANG Index, the different kind of bonds that we look at, the ETFs, the high yield, the investment grade, the world bonds, the corporate bonds, and the junk bonds, still in overall uptrends. Staples, even though they're showing some weakness, the tech sector and semiconductors are going up, high leverage loans, the Dow, the NASDAQ and NASDAQ 100, the NYSE Composite, as well as the Wilshire. All stocks, not only in the US, but outside the US, emerging markets, which are outside the US, and then Bitcoin, even though it's seen some recent weakness. So what's negative? This is when the 50-period simple moving average goes below the 200-period. Both the growth indexes and ETFs, they're still going down, as are the value indexes and ETFs. The CRB index is in a downtrend. The dollar's in a downtrend. ARK, even though it's getting close to possibly a golden cross, it hasn't quite done that yet. The micro caps, small caps, which are looking better, and the mid caps, which could be giving us a recent or a very soon golden cross here if they follow through with some more upward movement. Thank you. I really hope you found this helpful. I do post a video every day. I also have a weekly video. After I get done with this, I will be preparing what I call a deep dive video where I go through all the charts that I looked at over the last week, and maybe I didn't use them in a video, and I make a separate video just of those charts because sometimes we can get some good information that way. Have a great weekend, and I will talk to you in the next video.